Hello everyone. So in the last recording we saw mutual funds and ETFs, exchange traded funds. So we are going into other managed products in this chapter. So chapter 20 is all about other managed products. So in this chapter we are going to discuss different types of segregated funds. What is a segregated fund? Then we are going to discuss hedge funds, labor sponsored venture capital fund, close-ended funds, income trust, and listed private equity. So before we start with segregated funds, just to recap managed products. So all managed products are effectively a pool of capital that is put together by investors. It is given to a fund manager, and fund manager on behalf of every investor makes investments. Whatever return that investments generate, that are transferred to investors. So all managed products are effectively a pool of fund that is managed by a fund manager. Now we have seen mutual funds and exchange traded funds. So both of them do not have any kind of guarantee. So whatever investments you make into a mutual fund or an exchange traded fund, they do not come with any kind of guarantee. So capital you invest is always at risk. Now if you see segregated funds, they are considered to be an insurance product. So they are combination of insurance and investments. Features that they have maturity protection. So maturity amount is protected, it's guaranteed. Maturity amount is generally a percentage of amount you invest in. So a percentage of amount you invest in is always protected or guaranteed. There are death benefits. So if the person who has bought this segregated fund dies, means person on whose name the segregated fund is dies, then the beneficiaries get certain death benefits. And because it is an insurance product, it has creditor protection. So creditors cannot claim these products. So these products are formed as trust and they do not come. That means what happens is, in an insurance company, when you buy a segregated funds, so your the investments that the fund makes, it is not in your name, it is in the name of insurance company. That's the reason they are not attached if the creditor sues you, and they have creditor protection. So regulations of segregated funds, so they are individual variable insurance contract. So each time you buy a segregated fund, you make a contract with an insurance company. They are regulated by provincial insurance regulator. Now this is a key difference. Mutual funds and ETFs are regulated by provincial securities regulators, and insurance contracts are not regulated by securities because they are not investment products. So segregated funds are regulated by provincial insurance regulator. Canadian Life and Health Insurance Association provides guidelines which are accepted by most of the provinces. So this is an SRO. In case of mutual funds, it is MFDA, Mutual Funds Dealers Association. In terms of segregated funds, it is Canadian Life and Health Insurance Association. Office of the Superintendent of Financial Institutions is responsible to see capital adequacy of insurance company under Federal Insurance Companies Act. Then there is Assurus. Assurus is an insurance industry self-financing provider, covers only death benefit and maturity benefit. So what does Assurus do? Assurus protects you as a segregated fund buyer in case of there is default from the insurance company. So if insurance company files for bankruptcy and defaults, then you are protected. Protection is 60,000 or 85% of guaranteed amount. Whichever is lower is protected. Structure of segregated fund. So there is a concept of notional unit. So like I said, when you buy a segregated fund, the investment proceeds are always in the name of insurance company. You do not make investments in your own name. So in such a case, the insurance company does not give you actual units, but they give you notional units. Now these notional units are given so that it is easy to track performance of segregated funds. Now different parties that are involved in segregated funds. So there is a contract holder, the person who is responsible for buying the segregated fund. There is an annuitant, the person whose life is insured, and then there is beneficiary, the person who gets benefit out of this fund, who is named as a beneficiary. Now contract holder and annuitant can be same. So I can buy segregated funds in my own name, or I can buy segregated funds in my wife's name. In this case, the contract holder and the annuitant is different. So there should be an insurable interest in case of annuitant and the contract holder. So I cannot buy insurance on some third XYZ person that I don't know and name him as an annuitant, because there won't be any insurable interest. Now features of segregated fund. So there are maturity guarantees. So provincial regulations have that at least 75% of amount invested in a 10+ year period or on death is guaranteed. So provincial regulation says minimum 75% of what you invest in segregated fund, if the maturity is after 10 years or in case of death, is guaranteed. Now most of the segregated funds have much higher guarantee than that. They generally have 100% guarantee. So in a segregated fund, the amount you invest is most of the times guaranteed. Regulations permit that 75% should be guaranteed, but in practice generally 100% is guaranteed. Age restrictions, so no more than 80-year-old. So if you are buying a segregated funds, they are generally not available beyond the age of 80, and as your age progresses, the protection reduces. So there is reduced protection as you age. Now there is a concept of reset date. So if I have 30 years to go for my retirement, and I can buy segregated funds in chunks of 10 years. So every 10 years I can reset my segregated fund. So what happens when you reset? Whatever lock-in value would be there of the fund on reset date, that would be frozen as guaranteed amount. So example, I start a segregated fund with $10,000. After 10 years on maturity, the fair market value of that segregated fund is 20,000, and I put a reset. So what happens? Now the 20,000 becomes the invested amount, and then 20,000 is guaranteed, not the 10,000. So I can lock in my current market value on reset dates. Now in segregated fund, there is concept of death benefit. So death benefit is always guaranteed amount minus fair market value, and death benefit arises in case the guaranteed amount is more than fair market value. If guaranteed amount is less than fair market value, then death benefit is not there. Now what does death benefit means? So in case of death, you are provided with guaranteed amount or the market value of the fund, whichever is higher. So if your market value of the fund is 120,000 and guaranteed amount is 100,000, then you are provided 120,000. In that case, the death benefit from the fund is 0. Okay, but if the market value of the fund is 90,000 and guaranteed amount is 100,000, then you would be provided 100,000, though the funds are only worth 90,000. The difference of 10,000 will be provided as death benefit. So death benefit is always difference between guaranteed amount and fair market value. So in this case death benefit is 0, 100,000 minus 100,000. In this case death benefit is 10,000, 100,000 minus 90,000, 10,000. In this case death benefit is again 0 because fair market value is greater than guaranteed amount. One more significance of death benefit: death benefits are not taxable in Canada. So whatever death benefits you get, they are not taxed, and maturity amount is taxed. Creditor protection. So segregated funds have creditor protection. So under bankruptcy and family law, they are protected. So segregated funds are not attached to your properties in case of bankruptcy or if creditor is putting a lawsuit against you. Now there is a condition that segregated funds should be bought in good faith to qualify for credit protection. Segregated funds should be bought in good faith to qualify for credit protection. Means you cannot buy a segregated fund before 1 year of bankruptcy. So if there is a bankruptcy and segregated funds have been bought 1 year before the purchase, then they will not have any credit protection. They will come under bankruptcy assets. And if you are already legally insolvent, means you have already you are not a legally solvent person and you still buy segregated funds, then they will not have any credit protection. Also important thing, segregated funds bypass probate. So probate is a process whereby you prove or disprove a will in courts. So whatever will is there, you prove or disprove it in court. So segregated funds do not form part of will asset. Also important thing, there is no actual units that are distributed when you buy segregated funds. There are deemed units, or so deemed units, right? So whatever allocations you get, so dividend, capital gain or interest, so it is deemed income, so it is called as deemed allocation. So allocation, it is deemed income. NAV does not fall. So important thing, in both mutual fund and in ETF, whenever distributions are made, NAV generally falls. But in case of segregated funds, NAV does not fall. So fund contract receives additional income. And generally whatever allocations you get, like dividend, capital gains or interest, they increase adjusted cost basis of the fund. Okay. Tax treatments of guarantees, they are taxable as capital gain, and tax treatment of death benefits are tax free. Now comparison between an segregated fund and a mutual fund. So legal status, it is an insurance contract. Mutual fund, it is a securities. Owner of the fund, it's insurance company. In mutual fund, the fund owns it, so indirectly when you buy it, you own it. Nature of fund units, there is no legal status in segregated fund, and mutual fund, it's a legal property. Regulator, it is provincial insurance regulator. In case of mutual fund, it is provincial securities regulator. Issuer, it is insurance companies that issue segregated fund. In case of mutual fund, it is mutual fund companies. Main disclosure, it is information folder, and in mutual fund it is fund fact documents. So this is also a big difference. So mutual funds have fund fact documents and segregated funds have insurance folders. Frequency of valuation, segregated funds are valued daily, mutual funds are also valued daily. Redemption, it is upon request. Mutual fund, it is upon request. Required financial statements, so segregated funds need audited annual statements. Mutual funds have audited annual and unaudited semi-annual. Seller's qualification, you need to be a licensed insurance agent, plus you need courses like CSC. In mutual fund, you need to be a licensed mutual fund rep. Guaranteed amount, yes, it is there in segregated funds, it is not there in mutual funds. Protection against issuer insolvency, it is provided by assurance. Means if the insurance company defaults, your amount, means some amount is provided by, some kind of insurance is provided by assurance. In case of mutual fund, it is provided by MFDA, Investor Protection Corporation. Then there are death benefits in segregated funds. There are no death benefits in mutual fund. Credit protection is there in segregated funds. Credit protection is not there in mutual fund. It bypass probates. It doesn't bypass probate. Next is hedge funds. Now only thing you have to remember is hedge funds are similar to mutual funds. So there is a pool of money, there is a fund manager, and fund manager makes investment decisions. But important thing, they are not constrained by rules. So they have very less regulations. For example, if you invest in a mutual fund, mutual funds have lot of investment restrictions. A mutual fund cannot buy more than 10% of a stock in a company. So it cannot have concentrated positions. It cannot buy more than 10% voting rights. It cannot short sell. It cannot use leverage. It cannot use derivatives beyond permittable use. It cannot invest in commodities. It cannot take exposure to currencies. So there are a lot of restrictions that are put on mutual funds. Hedge funds do not have such restrictions. So they can take concentrated positions. They can invest more than 10% in one company. They can have more than 10% voting rights in one company. So they can they can short sell, they can use leverage, they can invest in currencies. So they can take exposure in commodities. So they are not constrained by rules. So mutual funds, you are allowed to take short positions, leverage, you can use derivatives beyond permissible use. So all these things are possible in hedge funds. Investing in hedge funds, so sales is allowed without prospectus for exempted investors. So if you're selling, okay, before going into that, you're not allowed to sell hedge funds to retail clients. The investor whom you're selling hedge fund as an advisor needs to be a sophisticated or an accredited investor. So if you're selling hedge funds to an accredited or a sophisticated investor, you do not need prospectus. Now what is an accredited investor? In Canada it is 1 million in assets, 1 million in net assets, or 200,000 of annual income, and 300,000 if it is joint account including spouse. Minimum investment exemption is there under National Instrument 45-106. That is, even if the investor doesn't qualify as an accredited investor, but he is putting 150,000 straight investment into a hedge fund, he can still invest. Then hedge funds do not offer prospectus. They are exempt from even offering. They generally offer memorandum. So hedge funds are sold by offering memorandums. They are not sold by offering prospectus. Benefits and risk by investing in hedge funds. Benefit: the correlation with traditional assets is very low. So hedge funds have very low correlations with traditional assets. And other biggest benefit that hedge funds have is absolute returns. So mutual funds will always have some kind of relative return. So mutual fund will always be judged against some benchmark. So that is their objective. Hedge funds generally have absolute return objective. So irrespective of what benchmark does or irrespective of what market does, hedge fund will have objective of getting, let's say, 4% return per year, right? Minimum. So irrespective of market going up, down or sideways, hedge fund has to attain that objective. So objectives of hedge fund is absolute returns irrespective of market conditions. Risk: their regulation is lighter regulatory oversight. There is manager and market risk. So hedge fund investments are heavily dependent on managers. So if manager quits, then it becomes very difficult to replace him and the performance may fall. Also there is market risk. So even though they have absolute return objectives, there is still market risk there. The investment strategies are quite complex, so they involve complex investment strategies. There are liquidity constraints, so they are not as liquid as mutual funds. There are lock-in periods when you invest in hedge funds, so there are liquidity constraints. Then there is business risk. Business risk means most of the mutual funds are big companies. Hedge funds, if you see, many of them are startups. So there is higher risk of failure in case of startups. So there is additional business risk when you invest in hedge funds. Now, a key component of hedge fund is incentive fees. What is incentive fees? Along with performance, along with management expense ratio, MERs, and along with commissions, you also have to give incentives to fund managers of hedge funds. Now incentives are dependent on performance of hedge fund. So in a mutual fund, you do not, means a fund manager is not awarded if the mutual fund performs really well, because mutual funds have commission structures for sales agents and have MERs, that is management expense ratio or fund management fees for fund managers. But in case of hedge funds, they have additional incentives if hedge fund performs really well. So there is incentive fees based on performance in case of hedge funds, which is not there in case of mutual funds. Now for incentive fees, there is a concept of high watermark and there is concept of hurdle rate. So what I'll do is I'll go to Excel and try to explain it to you. So what is high water mark? So let's say the fund was invested for 5 years and it started with 400 million, it went to 420 million, then it dropped to 380 million and it went back to 420, and finally the performance was it went to 475 million. So this was the fund performance of hedge fund. It started with 400 million, then it went to 420, then it went down to 380, then it came to 420, and then it came to 475. So what is high water mark? In case of high water mark, if you are considering performance of a particular year, highest value before that, highest fund value before that will be the watermark. So let's say you're considering performance of the hedge fund in second year. You're calculating incentive fees for performance of the hedge fund in second year. So whatever value the fund has before this second year will be the high watermark. So in case of second year, high watermark will be 400 million because that was the value previous to that year of the fund, highest value. Now in case of third year, the watermark will be 420 because if you are calculating fund performance in third year, then the watermark is previous highest value of the fund, so that is 420. The watermark in third year will be 420. Watermark in fourth year will also be 420 because previous highest value is still 420. So if you are calculating incentive fees, it will be still 420, and watermark in fifth year will still be 420 because that is the highest value before this. So what is a high watermark? High watermark means if you are looking at a performance of a hedge fund in particular year, highest value of that hedge fund before that year will be watermark. Now what does high watermark means? That if the fund beats the previous highest value, only then it will be paid incentive fees. For example, will incentive fees be paid in second year? Yes, because the watermark was 400 million and the value is 420, so it is above higher watermark, so incentive fees will be paid in second year. Third year it went down to 380, so will incentive fees be paid? No, because watermark is 420 and the current fund value is 380, so incentive fees will not be paid. In fourth year it is 420, so fund value went up from 380 to 420, so fund did grow in size, but it is still not beating the watermark of 420, so incentive fees will not be paid. In fifth year incentive fees will be paid because watermark is 420 and the fund value is 475. So this is how a high watermark is used. Next concept is hurdle rate. Hurdle rate means it is the minimum rate beyond which incentives are paid. For example, if a fund gives 10% rate of return, it fund grows 10% and the hurdle rate is 5%, so incentives will be paid on whatever performance is there above the hurdle rate. But if fund performed 3%, if fund grew 3% and the hurdle rate is 5%, there will be no incentives. If it is 10%, there will be incentives. Okay, so hurdle rate is the minimum rate you have to achieve as a fund manager to get incentives, and high watermark means it is the previous high of fund value that you have to beat to get incentives. Okay, now this is an interesting question. How much must a fund earn if the high watermark is 10% above the current value and hurdle rate is 3%? So fund must earn 10% plus 3%, 13% before it gets any incentives. Tax implications of hedge funds, it's quite complex because it depends where the funds invest in, but certain hedge funds use tax deferrals, so they invest in offshore investments and they use tax deferrals, so you don't have to pay tax unless and until you bring money back into Canada, so they use that structure. There is short selling and leverage in hedge funds. Now hedge fund strategies can be relative value strategy. In relative value strategy you arbitrage, so you buy an asset in one market and you sell it in another, and it is exactly same, so long and short is exactly same, so it is generally called as a risk-free strategy, and the market risk or beta of this risk is almost zero. So this works in upward market, sideways markets as well as downward market. So relative value strategy means arbitrage, buying in one market, selling in another, buying one asset, selling other asset. Okay, event driven strategies is generally done on particular events like mergers and acquisition. For example, if an acquisition is happening, so A company is buying B company, so as a hedge fund manager you will buy the target shares, B company shares, because generally after mergers the target shares appreciate, so it is based on mergers and acquisitions or any other corporate actions. Directional strategies is where you go long and short simultaneously, but long and short are not of exact same dollar amount or exact same value. For example, if you're going $100 long and $50 short, then it is a directional strategy because long is more than short. Same way, if you're going $100 short and $50 long, then it is still a directional strategy because short is more than long now. Now in case of directional strategy, I'll again go to Excel because there is a concept of hedged portion and unhedged portion. For example, if you're putting $100, if this is your trade, you're going $100 long and you're going $60 short. So you're going more long than you're going short. So what will be unhedged portion? Unhedged portion is always difference between the two. Whatever is long, bigger, long or short, minus whatever is shorter, whatever is small. So difference between the two is unhedged portion. Hedged portion is this lesser amount between long and short. So hedged portion is 60, that doesn't have any market risk, and unhedged portion is 40, that does have market risk. Now if this is the case, you're going $100 short and you're covering it up with $80 long. So this is your trade. So it is still a directional trade because long and short are not same. If they are same, then it is a relative value trade. Now what will you do? Unhedged portion will be difference 100 minus 80, and hedged portions will be the lower amount between 100 and 80, that is 80. Okay. So there are three strategies: relative value strategy, so long and short, or buying in one market, selling in another. So it is called as arbitrage, but they are of the same value. Market risk is relatively low. Event driven strategies done on specific events like mergers, acquisitions, etc. Market risk is medium, it does have exposure to market. Directional strategies have exposure to market, and it is going long and going short on the same stock, means on similar stocks, but not of the exact same amount. Now funds of funds, so these are mutual funds that invest in hedge funds. Minimum amount to invest is generally around 25,000. There can be a single strategy multi-manager fund. So such type of hedge funds invest in the same strategy. For example, if they only invest in relative value hedge funds, but they invest in multi-managers, so they invest in different hedge funds. Or there can be a multi-strategy multi-manager fund that invests in different strategies and then different managers within those strategies. Now what are funds of hedge funds? These are mutual funds that invest in hedge funds. So they reduce the risk that you are exposed to as a hedge fund investor to a single manager. Advantage of investing in funds of hedge funds: so there is proper due diligence. It is difficult for a single person to do due diligence on hedge funds because there are less regulations and they are not very transparent. So risk of due diligence is quite low if a mutual fund if a fund manager who is qualified does it for you. Reduced volatility, they are less volatile than individual hedge funds. There is professional management, they have access to hedge funds. Now like I have said, hedge funds are generally small startups, so it is sometimes difficult to get access to those hedge funds, so they have better access. Ability to diversify with smaller amount. By smaller amount you can invest in 10 different hedge funds or 20 different hedge funds. And there is manager and business risk control. Disadvantage: there is additional cost. Still there is no guarantee of positive returns. There is low or no strategy diversification. If you're investing in a single strategy multi-manager fund of fund, then there is no diversification of strategy. There can be insufficient or excessive diversification. So you can have a fund of fund only having 10 hedge funds, or you can have a fund of fund having 1000 hedge funds. So in case of that, there is excessive diversification. And they can have additional source of leverage. So they can borrow money and then invest in hedge funds, so that creates additional leverage. So difference between a mutual fund and a hedge fund. So mutual fund short position is limited there is limited use of short positions in close-ended funds, and generally they cannot use short sell. Hedge funds can do short selling. Use of derivatives is limited up to 10% of fund value. Hedge funds, they can use derivatives. Liquidity is high in case of mutual funds. Liquidity is quite restricted, so they have low liquidity in case of hedge funds. Sales method, they are sold with fund facts to general public. Hedge funds are sold with memorandums to sophisticated investors. So this is a big difference. They use fund fact document, they use memorandum, they are sold to general public, they are sold to sophisticated investor. Regulatory oversight is more in mutual fund, it is less in hedge funds. Fees, you have management fees in mutual fund, you have management as well as performance fees in hedge fund. Return objectives are relative in case of mutual funds, they are absolute in case of hedge funds. Valuation, mutual funds have daily valuation, hedge funds have monthly valuation. Disclosure, mutual funds generally have quarterly or annual disclosure. Hedge funds disclose their holdings annually, so they disclose to public annually. Position concentration is not allowed in mutual fund, it is allowed in hedge funds. Next is labor sponsored venture capital corporations. So these are structured to provide capitals for small to mid-size and emerging companies, and these are structured by labor organizations as well as labor unions of provinces. Advantages is, if you invest in labor sponsored venture capital corporation, you get a federal tax credit of 15%. Along with that, most of the provinces you also get provincial tax credit. I'm in Alberta, so it is not there in Alberta as well as it is not there in Ontario. Disadvantage, these are high risk and these are speculative investments because they invest in small and mid-sized companies. There is redemption restrictions, so if you redeem before 8 years, you have to pay back that tax credit. So that tax credit there is a clawback on that tax credit if you sell it before 8 years, and they have higher cost. Next is close-ended mutual funds. So these are midway between open-ended mutual funds and ETF. So close-ended mutual fund works, you give money to a fund manager issues you units, those units are listed on stock exchange, so it provides liquidity by listing its units on stock exchange. Difference between an ETF and an close-ended mutual funds, ETF, like we saw in last class, they have in-kind redemption and creation process. Close-ended mutual funds do not have in-kind creation and redemption process. Advantage, they have lower management fees than an open-ended mutual fund. Important fact, they mostly trade at a discount to NAV. Even though they're listed, their units are listed on exchanges, they trade at a discount to NAV, and this discount generally increases in a bear market. Ability to buy back, so there can be an interval or a close-ended discretionary fund which has certain buyback provisions into it, because generally close-ended funds do not have buyback provisions. So when they get money from investors and they issue units, that's it. Investors cannot go back to fund and ask for money. But certain close-ended funds can have buyback mechanism. Then if they have buyback, then they are called as interval or close-ended discretionary funds. Advantages, so they have advantage of diversification. Short selling is allowed in close-ended mutual fund. They have less cash drag, so most of the funds that the close-ended mutual fund gets, they are invested, so they have less cash drag. They have long-term outlook, and capital gain and dividend are directly paid to investors. There is no reinvestment, so adjusted cost basis is easy to calculate. Disadvantage, bear market, as I have discussed, they generally trade at a discount to their NAV when they trade on exchange, but this discount generally amplifies when there is bear market. they are less liquid, there is no reinvestment risk, so reinvestment risk is low, so no schedule for declining deferred sales fees. So they are less liquid, even though they are traded on stock exchanges, the liquidity is quite low. Reinvestment of dividends or capital gains doesn't happen, so it is directly paid into your account. Then generally mutual funds have declining sales commission or declining back end loads. When you sell the mutual fund, you have to, in certain cases you have to pay certain commissions, and they go down as the time period of holding increases. But in case of closed-ended mutual funds, it is fixed, so there is no schedule for declining sales deferral fees. If traded on foreign exchange, they are considered to have foreign income. Next is income trust. Income trust is like mutual funds, so they pool money and then they invest, but investments are not done in stocks and bonds. They are done in either real estates, either conventional real estate like commercial or residential real estate properties, or it is done in assets of business, not stocks and bonds of a business, directly asset of a business. So REITs is real estate investment trust. So these are mutual funds that invest in actual real estate, so they buy commercial and residential properties. They are good hedge against inflation because of real estate investments. They have better liquidity than the real estate properties because they are traded on exchange, and they have professional management. Business trust is similar to REITs, but instead of buying actual real estate, they buy business assets. So they may buy a restaurant, they may buy some supply chain, or they may buy cars, etc. And whatever income they generate from that asset, they keep. Taxation. Generally income trusts are taxed like Canadian companies, so they have to pay tax, but there is a pass-through status for REITs if they distribute income. So in case of REITs, if they are distributing income, then they have a pass-through status, so there is no taxation that REIT has to pay, but whatever distributions the investor gets, they are taxed in investor's hand. Next is listed private equity. So private equity generally invest in unlisted companies. Listed private equity means this private equity is then traded on stock exchange, so it has little bit of more liquidity. Strategies that listed private equity invest in: leverage buyout, so taking on loans and buying a company, or combination of loan and equity to buy a company. Growth capital, providing capital for growing companies. Turnaround, investing in out of favor industries and hoping for a turnaround, means investing in out of favor distressed stocks and hoping for a turnaround. Early stage venture capital, investing in companies that have yet to prove that idea. Late stage venture capital, investing in companies that have little bit track record but they are still not profitable. Distressed debt, buying debt of government or of companies that is currently under stress. Advantages, it is you can get access to legitimate insider information. Private equity can have concentrated positions, and private equity, difference between a private equity firm and a mutual fund is mutual funds does not take part in day-to-day, means in strategic decisions of the company that they invest in, but private equity players, they take part in running the business, so they have access to insider information and that is legitimate. They can have influence over management and flexibility of implementation, so they get all business plans from management, they can discuss with management, so all such flexibility is there. Disadvantage, though they are traded on stock exchange, some of them, but they are still illiquid, and there is dependence on key personnel, so they have manager risk. If the manager leaves, then the strategy goes along with him. So that is it. In chapter 20 we'll discuss more about other managed products in 21.